Hi folks, Chuck Gibson from Financial Perspectives with November 2018's Charts on the Move. Not having produced a video last month and reviewing the charts getting ready for this month, it seems like over the past 2 months, things have gone from bad to worse. Risk assets are being sold in earnest and have pushed most of the world's stock markets into the 20% plus correction territory. There is one notable exception. In this video, I wanted to let you see the deterioration that has occurred across the globe. I have almost 24 charts, so if I have any plans to keep this video to 10-minute limit, I'll have to flip through them and at a fast clip. The good news is, as you will see, the charts looks very similar, so if you blink and miss one, it won't take away from the bigger picture. I'm going to do a whirlwind look across the globe, touching on some individual countries, but also the major regions. Let's kick this off in Europe. The first chart is that of what probably is the most important economy in Europe, Germany. You can see in this 5-year chart that ends in the first quarter of 2018, their stock market broke out to new all-time highs here, immediately consolidated, and eventually jumped strongly higher. Notice how after the breakout price continues to make higher highs and higher lows, the mark of an uptrend. Additionally, it stayed well above its rising 200-day moving average, indication of strength of the trend. The next chart is the same view of the German stock index, but has been brought to the present to include prices as of the close of November. As you can see, the index's price peaked here in January of this year, sold off, consolidated lower, and eventually came under much stronger selling pressure. Notice how price gapped below the prior breakout to all-time high levels? This is a significant bearish technical event. I want to draw your attention to something in the chart that will be a consistent theme in every chart going forward. This almost 2-year rounded top. This is what price topping pattern looks like, so memorize it as it's a way to minimize further investment capital losses when it occurs. After prices peaked, it went on to make lower lows and lower highs, and the 200-day moving average went from rising to flattening to eventually falling. These are the two hallmarks in a downtrend. So far, Germany's stock index has fallen 25% peak to trough. The one little piece of good news is in this chart is that it's filled this open gap and is now sporting positive momentum divergence. Whether this leads to the end of a downtrend or just a short-term bounce will only be known in the future. The next chart is that of Italy's stock market. In January of this year, while in a strong uptrend and above its 200-day moving average, it broke out to new all-time highs. But that breakout was short-lived, as you can see when you fast forward to include the present time frame. As Italian stocks failed to hold on to new highs, it formed the same long-term rounded top pattern and has gone on to fall 27% peak to trough. Like Germany, it's filled the gap and formed minor positive divergence, but has a look as if it's set up to go much lower. Distribution is in play, as you can see by the near-term large and continuous selling pressure evidenced in the big red volume bars here. Taking a look at Spain, their stock market was noticeably weaker than both Italy's and Germany's, as price was unable to break out to new all-time highs before it eventually topped in January. In spite of that, it was still above its rising 200-day moving average. Bringing the chart up to date, it should start to look familiar. Like the other European stock markets, it formed a rounded top, which has led to a 25% decline. Price is now below a falling 200-day moving average and is making lower lows and lower highs. If you are long Spain and wishing to exit, it's great to see this positive divergence forming, as it will likely provide an opportunity to sell your position on what looks like as a setup for a near-term counter-trend bounce. My last chart for Europe is an aggregate tracking index which incorporates all European stock markets. Because Germany is its biggest component, it looks nearly exact. Same story, price broke out to new all-time highs last year, back-tested the level before launching strongly higher. Moving to the next chart, which brings us current, shows price has fallen back below those prior all-time high breakout levels, formed and confirmed the rounded top, and has declined 19% so far. Because its price is below a falling 200-day moving average and sits under a huge amount of overhead supply from the almost 2-year topping pattern, it looks like it wants lower. Looking left, we see this unfilled gap below here, which acts much like a magnet to iron, drawing price down in an attempt to fill. The one bright spot, something that has been consistent in most European stock markets, is the noticeable positive momentum divergence. It's set up for a near-term bounce, but someone or something will need to do a diving catch in the end zone to keep their stock markets from retesting these 2016 lows. As you can see in the next chart of the emerging markets, they look very similar to Europe's aggregate index, as they broke out to new highs before topping in January. Since that time, prices formed the same 2-year topping pattern and has not been able to hold all-time high breakout levels. In this case, the emerging markets has fallen 27% peak to trough, but is not oversold, nor has it formed positive divergence, with price well below its falling 200-day moving average. There is, at least as of November's close, nothing constructive that is developing and hinting of a reversal or end to the downtrend. Until that changes, the emerging markets are something, unless you're a short seller, to avoid. Moving over to Asia, looking at the Hong Kong stock market, we can see price was in a strong uptrend and substantially above its prior all-time high breakout level before peaking in January. Moving to an up-to-date chart, Hong Kong looks weak, but much stronger technically than Europe. The good news is price found support and bounced right where you expect it to at 2015's all-time high breakout levels and currently remains above it. The downside is price has lost 20% peak to trough and is still below its falling 200-day moving average, something that would need to change before considering being long Hong Kong stocks. Jumping over to Taiwan, it's almost an exact duplicate of Hong Kong's market, both leading into January's peak and the subsequent price action closing out November. Most importantly though, price is at least so far still above its prior breakout above all-time high level, which should act as future support if prices were to probe lower. Before peaking, South Korea's stocks moved lockstep in direction and magnitude with Taiwan and Hong Kong. But since topping, Korea has been substantially weaker as price has fallen 28% and sits under prior all-time high breakout levels. The repeating 2-year topping pattern is also in play, but in this case without positive backdrop of any momentum divergence. Looking at my next chart of the aggregate Asian stock index, it looks exactly as you'd expect, peaking in January, rolling over creating the rounded top pattern, and falling, in this case 27% since. Like the individual countries that make up the index, it's well below its falling 200-day moving average, but October and November's price action has been constructive in spite of the fact that it looks like a bear flag, as prices move back above its ever so important 2015 breakout high levels. I couldn't leave Asia without checking in on China, the target for most of President Trump's economic sanctions. Before looking at the chart, I wondered whether their stock market followed closely with other Asian countries, or whether it had been charting its own course due to the targeted acrimony coming from Washington. As you can see in the first chart that shows data through January this year, China's stock market was well below prior highs, but still in an uptrend as price was above its rising 200-day moving average. I'm pretty sure by now you have a good idea of what comes after the January peak. Maybe just not the magnitude. The sanctions and threats have weighed heavily on China's stock market as it's down 36%. The good news is it sits on important long-term support here and sports positive momentum divergence. To me, this looks the worst of all world stock markets, but it is set up for a potentially great rally if a rally were to be in the cards. This chart seems to be anticipating something pretty big. Could it be positioning for a deal to come from this weekend's meeting between Trump and Xi? If so, and it materializes, it will likely provide a wonderful short to intermediate term investment opportunity. If it breaks down or has an outcome of no change, watch out below. The 2014 lows look like a likely target if that's the case. I'd also expect not only would it be watch out below for China, but also a continuation of more downside for the rest of the world's stock markets. I saved the US for last as I wanted you to have a perspective on what was going on around the globe before viewing US equities. As you've seen, virtually every stock market around the world looks very similar. Some may be slightly less beat up, while others are in worse shape like China. 2018 has been a tough year for global stocks. Keeping the same format, the first chart is that of the US total stock market index into January this year. Looks similar to the other charts, just stronger. Price was way extended above its 200-day moving average and had been massively overbought, both of which warn price has gone too far, too fast, something I had mentioned in past videos and blog posts. but also a testament to its strength. The next chart is bringing the chart up to date. After the 11% correction here in January, February, unlike the rest of the world stock markets, ours rallied higher and went on to make another higher high, eventually peaking in September, not January, after forming negative momentum divergence. Within 2 weeks, price collapsed 12% below prior highs on huge volume, a sign institutional big money was leading the selling parade. Seeing the breakdown and how it unfolded, I made a weekend video at the end of October, warning of what happened and why I had turned short-term cautious. It should be clear, U.S. stocks have fared much better than every other major market around the globe, only falling 12%. Yeah, I said only. My concern now is that the risk appetite for global investors, which was weak but still pumping money into the U.S., may have now changed. It was great for our clients as we had identified this trend months ago and continued to keep accounts invested in only that strength. But during that time, I was worried how long would it be before investors threw in the towel and exited stocks altogether, leaving the U.S. markets to follow the rest of the world lower. Unfortunately, that was a risk we still don't have an answer to. So until we see price action confirming the U.S. failed breakout to all-time highs was nothing more than an overreaction to the change in economic and political landscape, I've changed my view of equities to that of being more neutral. As we move forward, if we fail to move beyond September's highs and instead move and hold below March's low, my view will immediately turn from neutral to negative and will be making wholesale risk reduction moves in client accounts. Don't get me wrong, everything is not doom and gloom. As you've seen, we're the only major global stock market that is still in an uptrend as defined by price making higher highs and higher lows. Granted, the 200-day moving average of our index has flattened out, but it is not, like every other market we've viewed, falling. In addition, we have positive RSI divergence and we are still in the bullish momentum zone, which are all technically constructive and point to the possibility of at least one more rally. All we need is a catalyst. Did I mention the Trump-Xi meeting that is happening this weekend where they will address the current trade situation and see if they can resolve this economic and market overhang? Whichever way it turns out will likely be the direction for the world stock market's next move. Stay tuned. Sorry for running long. Until next month when we close out 2018, as always, appreciate your time and attention. Hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with November 2018's Charts on the Move.